Welcome to Breaking News to Trading Moves. Look, we all know the golden rule of trading, right? Risk the exact same amount on every single trade.
Yeah, it's pretty much the first thing you learn.
Exactly. Protect your capital, keep your position sizing strictly static, and whatever you do, never deviate from that. But let's think about how structural engineers build a suspension bridge.
Okay.
They don't just run the exact same thickness of steel cable for every single suspension line. They calculate the stress points, they run the math, and they allocate maximum structural reinforcement strictly to the load-bearing sections that mathematically require it.
Right, they adapt to the specific load.
Yes. And that brings us to the core of our discussion today. We want to connect the dots on a very specific tension in the material regarding strategic risk allocation. Is it optimal to strictly risk the exact same amount of capital on every single trade, or does a premier high-probability setup warrant a higher risk allocation?
It's a debate that really divides professionals.
It really does. I take the side of dynamic, tiered risk allocation. My perspective is that when a setup is mathematically proven to possess a superior edge, while treating it like an average trade is unnecessarily conservative, it's just capital inefficient.
And I take the exact opposing view on this. Varying your risk size threatens the strict mechanical execution of your entire system. The moment you allow subjective interpretation into position sizing, you open the door to emotional biases. Let me just add, it leads to false conviction, and ultimately that destroys the baseline mathematical edge that makes a trading system profitable in the first place. Static risk is really your primary safeguard against human error.
All right, well, let's lay out exactly how this tiered risk model operates, because it all rests on the reality that not all valid trades hold the exact same mathematical weight.
Right.
We know that a standard pattern might win, say, 55% of the time over a large sample size. That is a valid, tradable edge. It gets you into the market. But there are specific instances where that exact same pattern aligns with a broader set of confirming variables.
You're referring to the conditions that elevate a standard trade to what the material calls an A-plus setup.
Precisely. We are talking about instances where the higher timeframe trend is in complete agreement with the execution timeframe. We're looking at price producing a very clear, unambiguous reaction from a major established level. And we have expanding volume confirming the direction of the move. When all of these factors align, the expectancy of that specific iteration of the pattern improves.
And just to clarify for everyone listening, expectancy is the mathematical average of what you can expect to make or lose per trade over the long run.
Right, exactly. So if your expectancy goes up because the setup is objectively better, treating that average setup exactly the same as this premier setup is inefficient. By employing a written, physical A-plus checklist before entry, you can objectively justify allocating slightly more risk to your highest quality opportunities.
I mean, mathematically, that makes sense. If you have a higher probability of winning, you should put more capital behind it. But we have to look at how this translates to live execution.
Okay.
My position is based on the reality that confidence is not probability, and the human brain is exceptionally poor at distinguishing between the two. Fast price movement or aggressively bullish commentary can manufacture a profound sense of conviction. You feel an intense urgency. You feel certain the trade will work.
But excitement is the enemy of math. The distinction must come from tested rules, not how your heart rate is reacting to a green candle.
It must, yeah. But look at how humans actually behave when a system permits variable risk. We've all been there. You're in a drawdown, you see a mediocre setup, and you tell yourself it's an A-plus trade just so you can size up and make your money back.
Which is revenge trading.
Exactly. And that is the exact loophole variable risk creates. Once you tell a trader you are allowed to risk more on your best setups, they inevitably begin succumbing to labeling entirely standard everyday setups as A-plus.
Yeah.
They do it out of boredom. They do it to hit a daily profit target. By attempting to maximize the edge, they neutralize the system's baseline mathematics by exposing their capital to emotional whims.
Okay, so you are describing a trader who is operating purely on feel. A tiered risk model is explicitly designed to prevent exactly that through structural caps and rigid documentation. Let's move from the theoretical definitions of an A-plus setup to the practical reality of live execution.
Sure. But how does a document prevent a trader from misinterpreting a chart in real time? Think about what it takes to actually tick those checklist boxes off.
It takes objective data.
But is it always objective? If you need to evaluate market breadth, which is simply looking at how many individual stocks are participating in a broader market move, or if you need to evaluate momentum, those are moving targets.
Well, they fluctuate, yes.
Right. What does strong momentum look like when the right edge of the chart is completely blank and the candle is violently fluctuating? Are you looking at a 5-minute moving average of the advanced decline line? Are you just eyeballing a heat map?
It looks like a measurable rate of change, not a feeling.
In theory, yes. But in the heat of the moment, the desire to be in a trade easily colors how you perceive that market breadth or momentum. It is incredibly difficult to realistically evaluate a complex checklist without subjective bias creeping in.
I see your point, but
The material asserts the highest risk category should be exceedingly rare. If it requires subjective interpretation of a fluctuating indicator, it won't be rare. It will appear magically whenever the trader wants it to appear.
that assumes the checklist relies entirely on fuzzy logic, though. A clear reaction from an established price level is a visible price print. It happens or it doesn't. Expanding volume is a mathematical reality printed on the bottom of the screen.
Fair enough?
Furthermore, a tiered model does not mean doubling your size or swinging for the fences because you checked a few boxes. We are talking about highly restricted caps for this tiered risk.
Walk me through the mechanics of those caps then, because the math of the risk increases where many models fall apart completely.
All right, the framework is tightly grouped. Let's say your standard setup carries a 0.50% account risk,
Okay.
and the absolute premier A+ setup is capped at 0.75% account risk. We are talking about fractions of a percent here.
Let's put real numbers to this to see how the machinery of the math actually works.
Good idea. Imagine a trader with a $100,000 account. A 0.5% risk means they are risking $500 on a standard setup. A 0.75% risk means they are risking $750 on an A+ setup.
Right.
It is a difference of $250. We are not talking about recklessly betting half the account. We are talking about a highly calculated micro-adjustment.
$250 sounds negligible on a $100,000 balance, sure. But let's look at the relative mathematics of what you just described. Moving from $500 of risk to $750 of risk is a 50% relative increase in exposure.
That is accurate.
So if a trader miscategorizes trades consistently, which we know happens, they're increasing their drawdown velocity by 50% on their losing streaks.
If they miscategorize, yes.
The danger of making every trade special is a very real psychological trap. Once you give someone the authority to declare a chart special, the mundane becomes intolerable. They stop taking the standard 0.5% setups because they don't feel rewarding enough anymore.
Look, I understand the skepticism regarding human discipline, but this gradual increase, combined with the absolute requirement of a physical, completed checklist before entry, removes the emotional component.
If they follow it.
Right, assuming they follow the rules. You cannot risk that 0.75% unless the boxes for higher time frame structure, volume confirmation, and a logical stop loss are physically checked off on your desk. And the reason this matters is the math of the equity curve. When you get a heavily skewed, high probability setup, and you capture it with a 0.75% allocation instead of 0.5, your account grows faster. You accelerate drawdown recovery exponentially compared to static risk without ever exposing the account to ruin.
Well, a checklist definitely slows down impulsive behavior. I will agree with that. But let's talk about the post-trade data analysis required to actually validate these risk increases, because that is where the real work happens.
Think about a professional casino card counter playing blackjack.
Oh, the card counter is a perfect lens for this. Let's explore the mechanics of that.
A professional card counter does not bet the exact same amount of money on every single hand. If they did, the casino's built-in house edge would eventually grind their capital down to absolute zero.
Right, the math is against them by default.
Exactly. Instead, they play a baseline, minimal bet while the deck is neutral or unfavorable. They only elevate their risk, They only push a massive stack of chips into the center of the table when the mathematical count confirms that the remaining cards are heavily skewed in their favor.
Because the deck is rich in tens and aces.
Yes, based entirely on recorded outcomes, meaning the cards that have already been dealt, a trader should operate with the exact same mechanical logic.
Meaning they need to track their historical outcomes to prove the edge exists before they ever increase the bet.
Yes, you elevate risk only when standard and A-plus setups, which must be recorded entirely separately in your journal, prove that the A-plus tier consistently delivers superior metrics. Let's talk about profit factor, because that is the defining metric here.
Profit factor is simply the gross winning trades divided by the gross losing trades.
Exactly. But let's explain it practically so the listener can see why it dictates position sizing. Imagine your standard setups over the last 50 trades generated $10,000 in gross profit and took $6,000 in gross losses.
So that is a profit factor of roughly 1.6.
Yeah. For every dollar your system loses, it is printing $1.60. That is a solid system. But now imagine your meticulously filtered A-plus setups. Let's say over 50 trades, they generated $12,000 in profit, but only took $4,000 in losses.
Okay, that is a profit factor of 3.0. Every dollar lost prints $3.
Exactly. The numbers themselves are demanding a capital reallocation. You are seeing a clear divergence in performance based on specific repeatable conditions.
Assuming the data holds up.
Right. If the data proves the A-plus setups outperform the standard setups, failing to allocate slightly more capital to them is mathematically suboptimal. You are leaving your edge unexploited, just as a card counter would be if they failed to raise their bet when the true count was high.
It is a strong theoretical comparison, I'll give you that. But it completely ignores the fundamental difference between a blackjack shoe and the financial markets.
How so? Both rely on probabilities playing out over a large sample size?
Because a deck of cards is a closed mathematical loop. There are exactly 52 cards in a standard deck. If 4 aces have been played, there are 0 aces left. The probabilities are absolute, finite, and completely knowable.
Okay.
Financial markets, on the other hand, are open systems. There are millions of participants, central banks, algorithmic models, unexpected news events.
So the probabilities are never absolute?
Exactly. Even the best setup can fail. Higher probability never means certainty. In an open system, you can have your higher time frame trend, your perfect price level, and your expanding volume, the absolute perfect A-plus checklist. And a large institutional block order can hit the tape and invalidate the entire technical structure in 3 seconds.
Yeah, market mechanics certainly do not offer the guaranteed probability of a deck of cards. The open nature of the system means external variables can override technical structures.
And this leads directly to the psychological damage of the loss. When a card counter loses a maximum bet on a high count, they feel the pain, sure, but they know the math was exactly right. The system is closed.
Right.
When a trader pushes their chips into the middle and loses an elevated risk trade, a 0.75% A-plus setter, it inflicts a specific, destructive type of psychological damage.
Because they did everything right.
Yes, they checked all the boxes, they waited patiently, they took on that 50% relative risk increase. And the market still took their money. This often triggers a revenge trading spiral that a static 0.5% risk model naturally prevents.
But if the loss remains manageable, the psychological damage should be mitigated. A 0.75% loss is still less than 1% of the overall account. It is fully recoverable in 1 or 2 standard trades.
The monetary loss is manageable, yes. The blow to the trader's ego is the real risk. Furthermore, your entire premise relies on the trader possessing a meaningful historical sample to prove their A-plus category actually deserves more risk.
Which they should have.
In practice, requiring a meaningful historical sample is almost universally bypassed.
Because traders lack the patience to build the database.
Because they incorrectly elevate risk after merely 2 or 3 recent winners. 2 successful trades with expanding volume happen to work out, and the trader immediately mistakes short-term variance for long-term expectancy.
Yeah, I've seen that.
They declare, "I've found my A-plus setup," and immediately bump their risk to the highest tier. They do not have a robust sample size comparing win rates across different market conditions. They just have a feeling of invincibility masked as data.
But we cannot design optimal trading models based solely on the assumption that the operator will break the rules. We have to design models based on what yields the best mathematical outcome when the rules are followed strictly.
But a robust trading system must account for the reality of the operator. Human fallibility is the biggest variable in the system.
Which is why the data must lead. The burden of proof is entirely on the trader, not the trader's feelings. If the A-plus category does not consistently outperform in the recorded data, it does not deserve extra risk, period.
I will grant you that if a trader genuinely possesses hundreds of documented trades, cleanly separated by tier, and the A-plus category definitely outperforms across multiple market cycles, bull markets, bear markets, high volatility, low volatility, then a static risk model does leave money on the table.
Exactly.
But the highest risk category must remain exceptionally rare. You could limit A-plus trades to a specific number each week.
That kind of mechanical constraint artificially enforces the rarity of the setup. It forces you to truly filter your opportunities. If you only have 2 A-plus bullets to fire per week, you will not waste them on a mediocre chart just because you are bored.
It is a good safeguard, but I still maintain that for the vast majority of market participants, the effort required to separate, track, and objectively evaluate these tiers is overwhelming.
It is a lot of work.
Maintaining a fixed static risk on every single trade removes the decision fatigue entirely. It ensures that when a losing streak inevitably arrives, the drawdown is perfectly linear and predictable.
A linear drawdown provides immense psychological comfort, I agree. But a tiered approach, when verified by hard data, actually accelerates the recovery from that drawdown. When the market conditions align to provide those premier setups, your capital is deployed more efficiently to capture the upside.
Provided the trader does not freeze. Sometimes traders who use tiered risk become so afraid of losing their larger allocation that they hesitate. They stare at the chart and miss the exact A-plus setup they spent weeks waiting for because the pressure of the larger size paralyzes them.
Well, we have examined a profound tension here today. On one side, we have the pursuit of maximizing mathematical expectancy by allocating more capital to superior setups.
Right.
On the other side, we have the absolute necessity of preserving strict emotional control through the simplicity of fixed risk.
It is the balance between aggression and defense. Both approaches aim to protect the trader just through completely different mechanisms. We definitely agree that risk should never increase just because a trader feels certain. Confidence, fast price action, or a few recent winners are dangerous illusions. If risk is ever to be elevated, it must be highly restricted, it must be gradual, and it must be mathematically proven through rigorous separate data tracking.
The distinction has to come from tested rules. If a trader cannot clearly articulate why a trade meets every objective condition of their A-plus checklist before entering, they have no business altering their position size. The goal is not to gamble more. It is to ensure every possible loss remains absolutely controlled.
And that reflects the incredible value of thoroughly testing a trading model's rules before even considering a tiered risk approach. A trader must know their baseline metrics inside and out before they start introducing new variables.
Absolutely.
There is certainly much more to explore within this topic, particularly regarding how we use rolling metrics. A profit factor is not static. A system might have a profit factor of 2.2 over a lifetime, but over the last 20 trades, it might be 0.8 because market conditions have changed.
Tracking those metrics on a rolling basis allows a trader to see exactly when their A-plus setups are falling out of sync with the current market environment.
The exact metrics are where the truth hides. Without them, you are just guessing in an open system.
Yeah, and guessing is the fastest way to blow an account.
We will leave the final determination to the listener. You must evaluate whether your own thoroughly recorded trade data objectively justifies adopting a tiered risk model or if maintaining fixed, static risk is the safest, most reliable path for preserving your capital and your mental capital. Let's think back to our structural engineers building that suspension bridge. They don't guess where to put the thickest cables. They run the math, calculate the load, and allocate strength only where the numbers demand it. Does your trading journal provide that same level of mathematical proof? Or are you just guessing at the load?
A question every trader must answer, honestly.
Indeed. Thank you for listening.